What's going on, everyone? Welcome back to the channel. I'm Troy, and today we're breaking down one of the most popular income strategies out there, monthly dividend ETFs. We're going to cover what they are, how they work, why they pay monthly, the pros, the risks, and what beginners need to understand before jumping in. I'll also show you real examples like SCHD, QQQI, and some truly monthly payers. This is Stock Market Media. So first off, what are monthly dividend ETFs? A monthly dividend ETF is an exchange-traded fund that collects income from its holdings and pays it out to investors every single month. Instead of quarterly payments, most stocks like ETFs pay you 12 times a year. They're built for income investors, retirees, cash flow focused portfolios, and anyone who wants predictable monthly payouts. Think of them as income machines built to turn dividends, interest, and option premiums into regular monthly cash. So, why do some ETFs pay monthly? Monthly ETFs hold assets, naturally generate frequent income such as bonds, covered calls, REITs, preferred shares, high yield credit, or global dividend baskets. They're not magically creating money, they're just passing through the income they collect from their underlying holdings. So, what are some types of monthly dividend ETFs? Well, here's some major categories and some popular tickers to fit. So, bond and income ETFs. These hold government, corporate, high yield bonds, and other high income assets. They pay monthly because of interest, and coupons are frequent. HYLB is a high yield corporate bond ETF with regular income. HGG is a core bond ETF, often distributes monthly distributions. And then BND is a broad bond market exposure with steady payouts. Then there's covered call ETFs. These generate income by selling call options on stocks or indexes. High income, but limited upside because of the cap gains. These examples include QQQI, a NASDAQ-focused covered call ETF that pays frequent income. QYLD, they sell covered calls on the NASDAQ 100. RYLD sells covered calls on the Russell 2000. And JEPI, JEPI, they deal in equity and options income, and they're popular for monthly cash flow. These are some people to flock to when you see double-digit yields, but it comes with trade-offs. So, then there's REITs, which are heavy in real estate income ETFs. Real estate investment trusts, or a REIT, pay steady income from rents and properties. So, reliable income that you know is going to come every month. Examples include O, which is realty income, not an ETF, but a famous monthly dividend stock. Then there's STAG, another monthly paying REIT. REITs focus ETFs often pay quarterly, but some income-oriented funds structure monthly payouts. Then there's preferred ETFs. Preferred shares act like a hybrid between stocks and bonds with consistent payouts. Examples include PFFD, which is a global preferred securities ETF, and PFF, one of the largest preferred share ETFs. Then there's high yield dividend ETFs. These mix income sources, both dividend yields, REITs, preferreds, and bonds to maximize cash flow. Examples include DIV, which is a high yield, high dividend, low volatility ETF, and SDIV, a super global dividend ETF. So, where does SCHD fit and why it's different? Let's talk about SCHD because it always comes up in dividend conversations. It's so hard to say sometimes. SCHD is not a monthly dividend ETF. It pays quarterly. It focuses on high quality dividend growth companies. Lower yield than some high income ETFs, but stronger long-term total potential returns. Built for compounding and stability, not maximum monthly cash flow. So when you compare SCHD to something like QQQI or QYLD, you're really comparing growth-oriented dividend investing to income maximizing strategies. So, how do monthly dividends work? A dividend yield is an annual distribution divided by the share price. An example is an ETF pays $1.20 per year. The share price is $20. That means the yield is 6%. Yield goes up when price goes down, and that's where beginners get trapped. A 10 to 12% yield might look amazing, but the share price is slowly bleeding over time. Your total return could be disappointing. So, the most risks that people ignore with monthly dividend ETFs, even though they're great, they're not magic. All right, there's high yield traps. Very high yields, 10 to 15% or more. Often underlying weakness is something that signals that. It's just not sustainable. Price may be trending down while the yield looks attractive. So the price of the stock, let's say, for an example of a yield trap, MARO, M-A-R-O, 182% yield. Now that yield's not correct because that price evaluation was while it was at like $70, and compared to it being at like $6 now, the price comparison is so different. Because it had a dividend of $12 a year. Now it has a dividend of $6. So it's thinking about it per share. One share will get you $6 in dividends a year, and the share goes for $6.50 to $7 a share. So it's just looking at that yield is crazy, but it's not sustainable. Then there's the return of capital. Some funds maintain their monthly payout returning your own capital. That can erode your cost basis and confuse investors who think all distributions are income. Then there's price decay. Covered call ETFs like QQQI and QYLD, RYLD often drift downward over time. You're trading long-term growth for immediate income. Then there's interest rate sensitivity. Bond-heavy ETFs drop when interest rates rise. Your monthly income might stay similar, but your principal can fall. Then there's limited long-term growth. High-income strategies usually sacrifice the upside, but SCHD-style funds may grow more over 10 to 20 years, even with the lower current yield. Monthly income is great, but you need to understand that what you're trading off to get. So, then it brings us into the most important question when it comes to dividends. DRIP or take the cash? You have two main choices when dealing with monthly dividends or ETFs. DRIP, which is Drip Reinvestment Plan. It automatically buys more shares with each distribution. It creates a compounding effect over time, which is better for long-term wealth building. Or you could take the cash and use it for bills, lifestyle, or reinvest it somewhere else in another dividend ETF. It helps with budgeting and predictable cash flow, and is popular with retirees or income-focused investors. DRIP builds wealth. Cash flow builds lifestyle. Both are valid. It depends on your goals. So, who are monthly dividend ETFs best for? Monthly dividend ETFs are great. Income-focused investors, retirees who want predictable cash flow, people who like seeing money hit their account every month, and investors who prioritize cash flow over maximum growth. They're not ideal for high-growth investors, short-term traders chasing big upside, or anyone who looks at yield and ignores total return. So, here's the bottom line. Monthly ETFs pay income every 30 days using bonds, REITs, covered calls, preferreds, and high-yield stocks. QQQI, QYLD, RYLD, JEPI, DIV, SDIV, PFFD, and PFF are all examples of income-focused funds. SCHD is a quarterly dividend ETF, better suited for long-term compounding than pure monthly income. And yield isn't everything. You must look at price trends, total return, and whether there's a return of capital. DRIP can accelerate compounding, while taking cash supports a monthly income lifestyle, monthly income is powerful, but only if you understand the trade-offs behind the strategy. If you're building a passive income portfolio, monthly dividend ETFs can absolutely play a major role. Just make sure that you're not chasing yield blindly. Thanks for watching, and let's jump into the charts and look at how SCHD, QQQI, and a few monthly ETFs actually outperformed in the last 5 to 10 years. Thanks for watching, and if you like this kind of content, be sure to like and subscribe.